Welcome to the afternoon live stream. It is June 19th, 2025. The market did not trade today and it will resume tomorrow. Now, tomorrow, we're probably going to open lower because oil prices have gone up because the tension between Israel and Iran has escalated. So, oil is up. Since it's a commodity, it continues to trade. So, we're seeing oil prices go up. And at the same time, we've got Asia stocks are down. So we have the Shanghai down 0.79. The Hong Kong is down 2%. The Nikkei in Japan is down 1%. Over in Europe, they are open today. I think the market's already closed there. And in Germany, stocks are down more than 1%. In England, they were down 0.58%. In France, they were down 1.34. So it would seem that when we open tomorrow, we are going to open down tomorrow. And let's take a look. Where is my pre-market button? It's right here. It looks like the market is going to close, open 0.93% down, and then S&P futures down, NASDAQ down 1.1%. It's because of that oil. So I don't know that it's going to be a good Friday tomorrow, but maybe there'll be some good prices on stocks. Overall, stock prices are on the expensive side. We find ourselves with the NASDAQ year to date in the positive 1.69%. And if we look at the 5-year chart, the stock market's doing really well over the 5-year. And we're nearing an all-time high. All-time highs are just, I don't know, 1-2% from where we're at now. So we're about to touch all-time highs. So a 1% pullback tomorrow, not a big deal. Not a big deal at all. So we'll see where things go tomorrow, but it might be a little rough. We'll see. Kareem Biggins, good to see you, man. Thanks for tuning in. You were in the morning session, and I appreciate that. Thank you. And let me know what you want to talk about. I've got a string of stocks, and I thought we could look at what's trending most today, and we could take a look at those stocks. Mike, the dividend investor guy. Yeah. So I have time today, so I thought I'd stream a couple times, and I also am streaming during times that I normally don't stream. So maybe that was an opportunity today. So here I am. So Kareem Biggins, I was wondering on the difference between ETF and funds and growth stocks. So ETF, funds, and growth stocks. So ETFs and funds. So ETFs are electronically traded funds. So they have an algorithm. They may say, hey, we have a particular balance of stocks that we're going to have, and we're going to have a computer basically trade them. Where a fund could be a hedge fund. It could be something that's more professionally managed. For example, something that has a lot of movement. I know that Kathy Wood calls her ARK fund an ETF, but it's more like a fund because she's making changes to it. Like she just added Circle, which was really smart, and that's a fund. So a fund has a person managing the portfolio, moving things in and out, moving stocks in, changing the amount of shares that are invested in a particular stock. And usually ETFs are low transaction fees, where funds have a higher transaction fee. And I'm not convinced funds are worth it. Sometimes funds charge 1-2%, and the performance isn't very good. So you're like, what am I paying for? You're underperforming the market, the S&P, and you're charging me 1-2%. Forget about it. ETFs, like especially Vanguard ETFs, they might charge 0.2%, which is really low, and that could save you money. A 1% versus 0.2 on $1 million is quite a bit of money if you compound that over 10 years. So keep that in mind. So that's the difference between those two. Now, the last part of your question, and growth stocks, of course, growth stocks are individual stocks. So especially in the US, you're not paying to trade. So you would just buy those individual stocks and you would manage the balance of your stocks on your own. So you wouldn't pay any management fees. But you have higher risk, but potentially higher rates of return when you have individual stocks. So keep that in mind. All right, so yeah, now you're asking a good question. So why do banks and advisors tell us to invest in that? So advisors want you to go to funds for a couple of reasons. One of them is, they don't want to be on the hook if they say, hey, you should buy or you shouldn't buy Palantir, because then they're going to be held somewhat accountable to it. Like, hey, you told me not to buy Palantir back, 2 years ago, and I missed out on a 700% gain. So they don't like that at all. But if you're in a fund and there's like 100 or 200 stocks in there, it's not specific. Second is a lot of these banks and advisors, they get paid money when they refer you over to a fund. So those funds will pay advisors to bring clients to them. And really, they're getting paid a commission because over time, that firm will make money from the investor. That's very well known. One of the famous situations that played out, Bernie Madoff, right? He had a private fund that was a pyramid scheme, right? And it was a Ponzi scheme, excuse me. And a lot of advisors were taking clients to Bernie Madoff, not Bernie Sanders. And Bernie Madoff, obviously, he was committing a huge fraud. He was just operating a Ponzi scheme. That's the worst scenario possible. Is advisors kept taking clients to him, and when clients that lost money tried to do class action against the advisors, there was no accountability, none. They were not held accountable. They were not held responsible in any way for the fraud that was committed, because they just said, hey, it's a pretty good investment. Here's a prospectus, make your own decision. And that was that. But they were paid money to get clients over there. So yeah, there is, as we think about Wall Street, you think about all these big firms, you see these big names on Wall Street. And I'm sure for some people, the big firms that manage big funds, they bring a lot of value to some people, okay? Because some people are like, they just don't get finance. They don't get investing. They don't like to take chances. They play it safe every way they can. And they can't stomach, maybe a couple bad days on Wall Street and stuff. So for them, great, they provide a service. But to those that are probably seeking a higher rate of return, are seeking higher income in life, right? Like, I didn't settle for the first job I had. I kept improving my skills and improving myself as a professional, and I made more and more money over time. And that's the same thing I've done with my investing. Is I didn't settle for the returns that these funds had. Like, I could probably do better. And I read books and I started doing my modeling, and now I do far better than if I was in funds. More importantly, I've built a knowledge base and a skill set to be able to invest better. So that's kind of like the big decision, right? Do you want to have others manage your wealth, or do you want to manage it? And if you manage it yourself and you're willing to put in the time, you're willing to learn and really operate where you can really understand stocks and sectors and industries that you understand, you're probably going to grow your knowledge and be more capable over time. So thanks for asking. Metal Notice, hello to you. Thanks for joining. Appreciate it. Mike, the dividend investor guy. HAFN. I think that's a shipping stock. And then I sold, so Mike, I sold a covered call a few days ago on SoFi. Can't believe I'm probably going to get taken. Oh, it's going to be, your shares are going to be called away. Yeah, you know, those types of options, I did that and it does generate some income, but it throws off my overall strategy. And I feel like I lost more money than I ever gained. When I do those options, I gain a couple $100, but I put thousands of dollars at risk. You know, the case in point is I've had 3M called away and I built back my position, but on that particular trade, I probably lost, I don't know, $4,000, $5,000, $6,000. And all I gained was a couple $100. It's like, nah, I'm not going to do that anymore. So I don't do covered calls and I don't do many options. I just try to invest in really good companies, keep it simple, and see those companies go up in value. Like I did a video for members on a CTRE, and it's a real estate investment trust. I'm up nicely on that stock, and I've owned it for multiple years. Pays a nice dividend. I think my yield now is 7.4. What's there not to like about that? I don't want to put that up, you know, at risk of covered call. So not a big options guy, but some people make that work. So if it works for them, good for them. And Mike, you have CTRE as well. Yeah, CTRE is one of those set it and forget it stocks. It's been really reliable, which I like. All right, so let's jump into looking at some stocks. I think I talked about the conflict in Iran and Israel, which is affecting oil prices. I think that's going to take us down tomorrow. Now let's take a look at some stocks. So HAFN is Hafnia. It's a shipping company, right? So Hafnia Limited owns and operates oil product tankers in Bermuda. Now I know why you're asking. It operates through long range 2, long range 1, medium range, handy size specialized segments. Okay. Well, now that we have higher oil prices, will Hafnia be in higher demand? Well, I would think that now oil prices were down yesterday, so I understand this fall it's beginning to rally a little bit in after hours. But let's take a look at the monthly. Yeah, as oil has been increasing, this stock has been increasing in value, and it looks like it's up 65 cents. So that would be about 12% in stock price. They pay a really high dividend. Historically, they've been higher, up to almost $9 per share. They've come down. Oil prices have been picking up, so now they're in a rally mode. If we're in this conflict in the Middle East for a long time, this particular company, Hafnia, is probably going to go up in value quite nicely. Let me see if I can do it. Yeah, here we go. Because I think this stock is going to continue to go up. Meanwhile, you're going to be paid a nice dividend. So let's take a look at their cash flow, see if they can afford that dividend. So as you guys have seen multiple stocks, when I look at revenue and I look at profits and so forth, for a company like Hafnia that's tied to a cyclical industry like oil, I can do that, but I can't do that at the same time, because sometimes if the oil price goes way down, there's less volumes, the rates on shipping are going to go way down. It's not to any fault of Hafnia. And so I'm not fixated on revenue growth when it comes to Hafnia or oil companies. What I am fixated on is how is that actual commodity going to trade going forward? Is it on its way up, which is going to enable Hafnia to make more money, as well as the oil companies? And that's what I'm focused on right now. So I'm not going to totally go into the revenue growth rate. When oil prices spike, you see their revenue really cranks up. Oil was really high in 2022. You see that revenue gain. So if we see that spike in oil and it stays up there, it stays elevated for a long time, these guys will make a lot of money. Free cash flow looks good. Really nice free cash flow. What's the free cash flow per share? Did they give us that? Yeah, per share 167. That looks good. And they pay a dividend of 91 cents. So they can afford that dividend. Shouldn't be a problem. Do they have debt? Not too bad. So they have about $878 million of debt. Okay. It is sizable debt considering that they don't have a lot of revenue. What's debt to EBITDA? Debt to EBITDA 1.34. So that's fine. Okay. The ratio is good. It has to be under 3, debt to EBITDA. Okay. So balance sheet looks good. Really, the question is, do you believe oil prices are going to stay elevated? If that's the answer, this stock's going to do well. If you think oil prices are going to go down, this is going to have a very short rally and it's probably going to sell off. So what's my guess on oil is you got to revisit it week to week, month to month, but it seems like we're going to be elevated for probably about a month, maybe longer. And the tension is brewing. I don't know if it's posturing from Iran, but if we're in this thing for like 6 months, I think Hafnia and Oxy, which is Occidental Petroleum, Chevron, Exxon, all those guys are going to make a lot of money because the oil price is going to be elevated. They make more revenue when the oil price is elevated, and it'll be good for that industry. Now, I hope that conflict gets resolved sooner than later. I'd rather have the conflict go away and my Chevron stock doesn't rally, my Oxy stock doesn't rally. I'd rather have peace in the Middle East. So that's Hafnia. I could see these stocks really moving. All right, so looks like Kareem Biggins, you want to look at Zim and Pfizer. Yeah, we can look at those. And we've got Pfizer. All right, looks good. Let me post a note. So the way that I work with tickers, if you're a member of the channel, it doesn't cost a lot, but I appreciate you guys joining. You can put up tickers in the chat, and I'll gladly take a look at them, review them, analyze them. If you're not a member, don't want to become a member, but you'd like me to review a ticker, $5 super chat, and I can take a look at that stock. Looks like Blocks for Fun is in the stream. Very good to see you. Thanks for joining. And let me know, Blocks for Fun, if there's a stock out there you want me to look at. I think last time you joined, you did have a stock that we dug deep into. All right, so we went over HAFN. Let's take a peek at Zim. Zim is somewhat related to Hafnia. It is a shipping company. But they don't ship oil. They ship principally containers with stuff, right? A lot of stuff coming from China, going to the United States, to the West Coast, to the East Coast, from China to Europe, China to all kinds of places. And Zim is an Israeli company. So they're a $2 billion market cap company. Revenue is much higher. This dividend, it looks really high because they had a one-time special dividend. So don't expect that you to get a 47% dividend going forward. Maybe they can, but it's probably just that one time. And we can look at the dividend history real quick. I think it'll give it to us here. So here's these dividends, right? These special dividends. And crazy amount of money there, right? Because if you bought the stock at $14 a share and you got dividend, close to $7, you got half of your investment back. So that was a pretty nice situation for investors. Not bad at all. But I don't know that that's going to happen again. They have to make a windfall of profits before they would do that. And back in 2022, believe it or not, these guys dividend $17 per share. Let's take a look at the share price. $17.72. Isn't that amazing? So yeah, they do pay lots of dividends, but it's based on their profitability. Now I looked at Zim. I own Zim, and Zim is solid. Some things I like about Zim. Let's go into their financials where I could explain in detail what I like. We could do a desirability analysis. We can look at the full valuation because I have that available for it. Okay, so Zim is a shipping company. They're shipping all kinds of cargo. Here's an example of what they do. Look at these monster big ships. Got all kinds of stuff in there. Got, home furnishing. You've got all kinds of stuff. Consumer packaged goods, all kinds of stuff that comes to the US. And they should have their financials. Here we go. So on May 19th, they announced their earnings. And this is May 19th. This is somewhat in the middle of the tariff, deal. Although this quarter represented before we had the, what did they call it? The Freedom Day, or when they announced the big tariffs. And they did okay. Let's take a look at their revenue growth and so forth. So net income was higher, so they made more money profitably. Revenues increased 28%, so that looks good. Looks really good. Okay. And one thing that I know about Zim, because I've been following them for a while, and here are their volumes. I'll go to that after I finish this quick story on Zim. So back when we had the supply chain issues coming out of COVID, if you recall, there was high inflation because there was scarcity. It was like, hey, China stopped production and we ran out of inventory in the United States. So businesses were paying to expedite shipments, and the ports were so overwhelmed that the ports were charging a fee to expedite the ships coming to port and getting offloaded. So there was just a lot of money that was made by Zim. That's why they paid that $17 dividend. But what they also did is they took a lot of that money they made and they bought new ships. So the Zim fleet is one of the newest fleets. It runs more efficient on fuel and it can operate more effectively, reliably. I think that gives them an advantage. That was smart that they did that. Now, when we look at their key financial data, revenues went up nicely. That looks good. Free cash more than doubled in the quarter. Very good. I think this is sequential. No, this is year over year. So year over year, cash flow looks good. Revenue looks good. Everything basically looks good about this company. So this company is going to be subjected to the swings in this particular industry. You have drastic swings. You have times when they get paid a big rate. There's lots of demand for shipping. And there's times when the amount of demand for shipping goes down and the rates go down and they can't operate with as much revenue and profit. But right now, I think they're in a good place. And Zim, when we look at the value of Zim, I mean, the cash they produce is quite impressive. And even if I bring it down, kind of bring it down so like my modeling doesn't spit out these overly crazy numbers, the value is just really high of the cash. They just generate so much cash and profit. Now you would think, why can't a company like this really sustain an upward trajectory on their stock price? And it's the market just doesn't do that with shipping stocks. So what I do is I invest in the company and I define my exit strategy when I invest. And my exit strategy is going to be once I'm up 50% on Zim, I'm out. And I think we can get there if the stock price can go up. I think if the stock price goes up for me to about $24 a share, I'll be good. No, $21 a share, then I'll be good. So if it hits that number, I'm out because the fundamentals are really good behind the company. I just have to be realistic. In this industry, you know, they said life isn't fair, right? And life is not fair for this industry. Sometimes it really beats it up. And sometimes, like in 2022, they were getting so much money per container. Like it literally was like 6x what they were typically getting. So they were making so much money. It was pretty neat. So Zim is a shipping company. This dividend, it's going to be a dividend. There's going to be a dividend, but is it going to be $8.50? I don't know. I wouldn't expect it. I wouldn't count on it. It's going to be a risky ride. If you look at Zim from a historical perspective, let's take a look at the volatility. So you see the volatility up and down, up and down. And more recently, it was really down. Right there when all the big tariff announcements came out, boy, this one went down. But it's made its way back. From that point, it's up 51%. And I think now, given the conflict that they're going to have to sail longer routes, you know, that maybe they can't sail near Iran or areas of conflict. And if they do that, they're going to have to charge more and they're going to be busier. The amount of shipping capacity isn't going to be as high as they expected. So those things are going to help Zim integrated shipping. It's going to give them higher rates, more to ship. Their vessels will be nice and busy. So I think the future looks pretty good, the immediate future. I need this stock to go up to $21, $22 a share, and then mission accomplished, and I'm out. And that's it. I need to be disciplined. I got my exit strategy defined on Zim. Now, most stocks, I don't have that going. Like when I buy Kroger, owned it for years. It just keeps doing what I expect it to do. I keep holding it. Meta, keep holding it. And I've got 90% of my stocks is if they do what I expect they're going to do, I'm going to hold them until they decide to do something different and I don't agree with it, then I might sell the stock. And who knows, maybe in 20 years time, I'll be quite a bit older and I'll be like, well, maybe I need to sell some stocks and put it into a different asset class, but I haven't gotten there. I'm not going to touch my stocks. I actually went to a wealth advisor that is provided to me through my broker. And I told him, you know, I'd say, get older, I think I need to de-risk. And he listened to me. And at the end of that segment, he said, well, I don't think you ought to do that. I think you ought to keep doing what you're doing. Keep taking risks because you're doing really well. And you shouldn't change kind of a recipe that's working. So I go, oh, well, I didn't expect that. Thanks. And I'm just going to keep at it. But who knows? Maybe someday I'll de-risk a little bit. So Zim is a good one. I like it. I'm buying it. And I'm actually in buy mode because I think it's got some good days ahead. I think it's got some really good weeks and months ahead. And I'd love to see this stock price get back to, boy, it'd be beautiful. It's 27, huh? Yeah. But don't get greedy because the guys who said, oh, yeah, this thing's going to keep going up, we're almost like within a month's time, we're down 32%. That's why we can't be greedy with Zim. If it hits your price, be ready to sell, get out because you can wait a week or two, and then it's really hard once it gets down that slippery slope, right, to sell, because you're like, oh, it's down 3%, it's down 5%. How can I sell on a red day like that? No, in my opinion, like, be very prescriptive. It hits that price, I'm out. Don't think twice. Take the money, bank it, and move on. I did that last time, and like a week, 2 weeks later, it started to crash, and I'm like, oh man, I'm glad I sold it. So this is a good way to make money, but you got to be wise about it. So that is Zim. And now we're going to talk about Pfizer. Now, I've heard some positive news brewing around Pfizer. Let's see what we've got. And this stock hasn't really performed well. The 1 year down 13.91, year to date down 10%. It has had somewhat of a rise since April 10th of 10.61, but overall this thing is not getting the job done, not performing up to snuff. Let's take a look here. So they pay a high dividend yield of 7% if you bought the stock at its current stock price, which is pretty attractive. So no like innovative news. It's just about the dividend, which I already knew about. I could have sworn that there was some news around that they either their drug or something was positive news. Let me check another source here. Then we'll take a look at the fundamentals. I'm still not seeing anything. Yeah, so nothing on the innovative side, just that the dividend is really high. Now this has a market cap of 135 billion, revenue of 62 billion. So you're paying 2 times revenue. It's pretty cheap. 17 PE, but next year it's going to go down to 850, real cheap. Analysts think it's discounted. Now, the revenue has been growing, but the latest quarter came in red, which surprised me. I thought they were on the upswing, showing 2 quarters of really nice growth. Then they had this negative quarter. If they can come in, when are they going to announce here? They're going to announce July 29th. So that's a month and call it a week and or so away. And when they announce, if they can announce a growth quarter, the stock's going to move up. They do make good money. They do have good free cash flow. They pay that dividend. Check out the cash flow, 11.2 billion, and they're a market cap sub 200 billion. This stock, if it's a grower, like if it grows 10, 15%, this thing can easily go up to 300 billion in market cap. And it could be a really nice gainer for an investor while you get paid a really nice dividend. So you'd win 2 ways because the cash flows are really strong with Pfizer. Their gross margins are really high at 74%, and they've improved them over time. Now back here, their margins were lower because they were selling a bunch of vaccines, but they were making money hand over fist back here. Their cash flow really went up. Look at this cash flow, 29.8 billion, 26 billion, because they were selling all the vaccines. So now they have really good fundamentals. They just got to grow that top line. They can grow that top line, this company's going to be worth a lot more. The analyst, 14 of them cover it, and there is a really optimistic analyst at a price target of $45, and that's almost double the stock price. And the worst case scenario is 24. So there's really very, low risk downside, very high upside. So that looks pretty interesting. So Pfizer's got some really good fundamentals. Looks pretty darn good. Let's take a look at their growth and profitability. Now the growth is expected to pretty much flatten out. That's kind of a bummer. I thought they were going to start growing because they acquired some businesses a couple years ago, and those businesses are beginning to produce revenues. And I thought that was going to add on to their overall revenue, but it looks like it's not, and their earnings per share isn't going to expand either. So this one here is not a buy. For me, I own it. I've been selling shares of it, and I could tell you I'd rather sell it than buy it. That's my opinion on Pfizer. Even though they generate a lot of cash flow and they have profits, if they're not going to grow, I got to find companies that are growing. They're discounted by 23%. I think I'm probably agreeing with the analyst on this one, but it's got to grow. If they don't grow, it's going to go. It's going to go off my portfolio. So I think the next quarterly earnings is going to be key. I've been selling Pfizer shares on up days just to kind of lighten up my position. And I've been buying Novo Nordisk. Novo Nordisk has, I think, a better situation. They're growing better, and have deemed it to be a better option for me in this category of large scale pharmaceuticals. These guys are 333 billion. They do a weight loss drug among other drugs. They're been beaten down. I don't understand why they're beaten down so bad, because when you look at their financials, they've been a nice grower. They've been a consistent grower. So I'm thinking the fundamentals are worth far more than where the stock market is pricing it. And when I look at Novo Nordisk, it's discounted by about the same amount, but I really fixate on that revenue line for most businesses because it really tells me, is that business desirable to the end customer, whoever is buying their pharmaceuticals? In the case of Novo Nordisk, people are buying those pharmaceuticals. It's a company that's selling products that work. More customers are buying their products. So I think it's a better investment if I invest in Novo Nordisk versus Pfizer. And Pfizer, I'll continue to lighten up my position there. So that's my opinion on Pfizer. It is a sell for me. All right, so let's take a look here. So also TKO. So TKO, yeah, we'll take a look at TKO. We looked at it, I'm going to say a month or two ago. Be good to look at it again. Yeah, I think, Mike, you were saying the same thing. They got to grow. You don't grow, I don't know what to do with you. Canada EVs. How do you feel about liquefied natural gas like VG? I don't have an opinion on it. I have an integrated oil company in Chevron. I believe they do natural gas, but that's as far as I go. I don't have a lot to add there. Thanks for the question. Okay, let's talk TKO. All right, so this is TKO year to date, up 23%. So TKO, entertainment company. Okay, they do. Is this wrestling? So yeah, it has UFC and WWE. PBR is bull riding, right? Yeah. Geez, man, bull riding. All these guys. So a couple of sports that I've never done, never will do, but think, see, these are some of the bravest athletes. UFC, you're in there alone. You against some other guy, and both athletes are just so conditioned, so skilled. And then bull riding, that wasn't hard enough. Get on a 3,000-pound muscular bull that wants to throw you off its back and stomp on you. Man, there are people that really put themselves out there. But we're not going to ride the bulls. We're not going to get in the cage with one of these fierce warriors. We're just going to try to make money. Year to date, this stock, man, look at this volatility. Oof. But this stock's up 23.81% year to date. 1 year, 69. That's a good looking graph. Nice upward trajectory. In the 5 year, I think they IPO'd back here. It's looking good looking chart. So 69% higher. 34.8 billion in market cap. Revenue is 2.85. So they are trading a little expensively, probably about 13 times revenue. So that's a little expensive. We'll see what their growth rate looks like. PE is expensive, 149. Again, we got to look at the growth. Analysts think it's a little expensive. It's probably expensive by 7%. The growth rate for the trailing 12 months is not very good. Previous years, very good, especially 23 and 24. But this may come, I believe that TKO grew by acquiring other businesses. And in my book, it's not as good as organic growth. When you acquire other businesses, it may prove to be a good acquisition, but it's just basically adding one business revenue to another business revenue. Both businesses may be not growing, but together it seems like they're growing because you just added a big business to it. So it's not as good as organic, but 10% growth over the trailing 12 months, that's pretty decent. But then when you look at the quarterly, then we got problems. I mean, this is not growing very much. Okay. Now, this type of entertainment, just from an economy perspective, this is a consumer discretionary entertainment, right? A couple of things. If you want to go to a WWE match, costs money. And I think if the economy isn't booming, maybe people don't go as often. And same thing with UFC. UFC tends to happen in Las Vegas and other places. And they usually have pay-per-view for UFC. I know specifically WWE, I believe, has a deal with one of the, I want to call it network. I don't know if that's the right term still. And they make that type of annuity by showing their matches on WWE on their channels. So having said that, I think there isn't a lot of discretionary spend available in the market going forward. It's not my expectation. I think businesses are going to struggle that have a discretionary spend service or experience or product. And these guys are in that category. They're beginning to feel it because that growth is really slowing down. And they have a high PE and they have a high cost of sales, right? Price to sales. So that revenue number is really making me shake my boots. Now, the free cash flow is 636. The current cash flow, maybe I can multiply it times 15 or 20. Even when I do that, I get to 12 billion. I'm going to be way short of their current market cap. So I'm not getting anywhere near that. Profit margin's pretty low. Wonder why. That is really low. So this one here is not going to be an investment for me. It's really hard to invest in a company like this. And I'm going to look at the debt. Debt's $2.6 billion of net debt. So just adding to the problem of getting to this market cap. This market cap is doing well. The stock's gone up nicely, but I think the stock is priced as a growth stock, but the problem is it's not growing. So I would not be surprised if the stock goes down by a good amount over the next year, because if they can't grow, you can't price this at the high PE ratios, at the fact that if you look at free cash flow, it's very hard to get an intrinsic value anywhere near its market cap. So this one here is not gonna do it for me. So that is TKO. It is a pass. And I've said no to a couple stocks this afternoon. Actually, I said yes to Zim. I said HAFN is really, if you think oil is going to go up, that's going to do well. So that's not a no. I said no to Pfizer, sell, and then TKO would be a sell. So that's how I see it. I'll give you my observation exactly the way I see it, and hopefully you understand my point of view. So Mike, you're looking potentially to sell out of Ali, to generate some cash. I think it's a good idea right now to generate some cash. I'll tell you high level. Well, let's take a look at Ali, but I'll explain why generating cash is a good idea. So UFC is currently looking to get rid of price per pay-per-view. Got it. Yeah, maybe it'll be interesting to look at it in a year or two, but for now, I think TKO is just stock price is way too expensive. All right, so it's not a bad time to start generating some cash. As mentioned earlier, when we look at the stock market, right, it's not a bad time to generate cash because we're nearing all-time highs. And are we going to go up into the right some? Maybe. Are we going to deal with a bad story? I mean, the whole Iran-Israel thing can get worse, and oil prices keep climbing, and that's going to bring the market down. If we hit $100 oil, the market's going to come down. I could be fairly confident that's going to happen because it always does. Is when high oil prices exist, stocks sell off because oil consumes so much of discretionary spend that there's less money to go around and people can't afford the other products and services. So that's an example. Now, if you're sitting on cash and let's say we do have a pullback of another 10, 20%, I mean, we had a solid pullback this year already where stocks pulled back 19% on the S&P. They pulled back even more on the NASDAQ. So if we have an event like that and you're sitting on some cash, you're going to be feeling wise, like, I'm glad I got cash because I'm going to be able to buy these businesses that I do want to own for a long time at a really nice discount. But if you don't have cash, it's really hard to sell into a declining market. It's just really hard. But you got to do it. But it's better to do it when nobody's selling, when you get to sell at high stock prices, just to create some cash. I'm not saying you go from being, 100% invested to 50. No, I'm saying like maybe you're 95% invested and you're like, I'd like to have more cash. Maybe you go to 90% invested, 85, and then you keep that cash somewhere that it's creating, that it's earning a good interest, which is easy to do right now with money market accounts. And then you're ready for a correction in the market and you're able to take advantage of it. Warren Buffett, I reviewed his portfolio earlier in the earlier live stream. And here's his portfolio. He's got $334 billion of cash. So Mike, I don't know how many billions you're going to accumulate in your cash drive, but Warren Buffett's got a lot of cash laying around. So he wants to be ready when the market's really correct. And I shouldn't say Warren Buffett anymore because it would be his successor, and the team would be ready to really take advantage of a market that's really sold off and asset prices have really dropped. They can buy at really reduced prices. In the meantime, they're going to earn an interest on that money because they invested in short-term T-bills. So it's not a bad idea to create cash. Not a bad idea. So Warren has just barely a little bit more cash. Yep. And okay. Yeah, I like how you're thinking, which is, I think if you're around 10% cash, that's not a bad idea because you're still invested. If the market keeps going higher, you're like, hey, going along for the ride. But if you have a really nice downturn, you probably have a list of stocks. You're like, oh, I'd love to have a better price on that company. And you're presented with that. So good thinking. All right. So let's take a look at Ally. What's Ally been doing? Ally is a financial company. They were born out of General Motors. General Motors had a part of their business called GMAC, which did all the financing on their cars. They spun them off, and these guys have been operating independent, doing financing for cars, as well as other things like mortgages and other forms of financing. They also do a little insurance now and other financial products. They're not doing great. Year to date, 2.3%. They are on an upward, rise over the last couple months, up 22%. They pay a dividend, 3.26% dividend. And this one here, like the base industry they support is automotive. And I am not optimistic about automotive. I think the economy is not booming. It's not struggling either. But I don't know that a lot of people are confident enough to say, oh, yeah, I want to buy a new car. I think people are going to probably be in the boat of, I'm going to make my car last a little longer. I'm going to wait until things are really good and then I'll buy a new car. And if they're not buying new cars or maybe a nicer used car than the one they have, Ally Financial doesn't get to do the financing. So that's my high level economy outlook. Let's take a look at how their company has been operated. So market cap's 11.3 billion, revenue is 6.6 billion, so about less than 2 times sales is the price of the company. The current PE is really high, but forward PE is nice and low. Okay. Revenue has not been growing. So this is interesting, not growing. Quarterly. So this was positive. Net interest income went up. And then non-interest income went down. Okay, but overall revenues have been declining. Look at all that red. Jeez. What's going on, Ally? So that's a lot of red on the overall revenue. That's concerning. Now, when everybody's getting stimulus checks, and I think the used car market was going through the roof because we had the supply chain issues, and new car companies couldn't produce cars because they didn't have all the parts. These guys were financing used cars at a higher rate, making lots of money. But those days are behind them. And I don't know that the car business is going to be all that great in 2025 and 2026. And the other thing that is a good news, bad news situation is cars just last longer. And we got a new car in November, got a really nice car. And we kept the old car. My wife, she takes care of her car. And I should say, we both take care of the car nicely. She is a good driver, garage the car. So we got the car we replaced for Mother's Day in 2013, and she drove the wheels off of it, and we got a new car in 2024 November, and we kept the old one. It's like in really good shape, and I sold another vehicle I had that was in good shape. Just cars are made better and they last a long time. So I think that's going to be part of the challenge for car companies. Now, EVs, I think, propose a different experience for the consumer. Hey, you don't have to pay for gasoline, buy an EV. We get high oil prices. You have got high gasoline prices. Maybe that's the drive for new cars. You go buy a new EV because then you don't have to pay for gasoline. You just have to, you know, plug it in and charge it up at home or however you want to charge it up. But these numbers don't look good. This is not looking good. The forecast for the economy not going to help them much. So this guy here is a sell for me. Just I'm seeing too many red flags, too many signals of risk, and I don't see a ton of upside. It's not like, hey, you know, if they can weather this problem, they can probably be worth a lot more money. I don't see that. They could be worth a little bit more money, but I see more downside risk than I see opportunity for the stock to rise. So my valuation on Ali, it's a good company, it's discounted, but that top line revenue is not getting it done. If you can't grow, it just tells me this business is not going to work in the future. Something is pulling revenues away. Is it that there's another finance option that's taking away customers? Customers don't like the financing that Ali provides. Our car companies, I know that car companies may get more desperate and more desperate. I was seeing ads for 0% interest. Well, if you have 0% interest, it's hard to make money, right? So I don't know how they make money in those situations, but in the case for Ali, I just think there's too many red flags. So I would be a seller of Ali. Get out of it, and there's plenty of other companies that do great with. If we're going to talk about financials, there's terrific financial stocks. I mean, Citibank is an example. That's a big bank. I thought it was the best priced bank, so I bought it. Year to date, up 11%, 1 year up 30%, pays you a 3% dividend, but they're not to like. So Citigroup, I think, is a better choice than Ali. I think there's fewer red flags, better place to park some money if you want to be in a finance company. Citi's there. If you want to take higher risk, I mean, the boat's left on Robinhood, but Coinbase is a financial services company, and that's a higher risk. It's been flourishing, but picking the right spots, being patient, you know, increasing your cash balance so you can be patient and you can wait for some of these awesome stocks to come down in price. Let's say a Robinhood, right? I'm big on Robinhood. And this guy here, you can see that it had a substantial sell-off in April, like with a lot of other stocks. I bought more shares. And then it just decided, well, let's go. Everybody hang on because we're going to go up 127% in 2 months. Whew. So this guy, I don't know when it's going to come down to a reasonable price, but looking at quality companies that you believe in and being patient and sitting on cash earning 4%, that's the recipe for success versus just chasing, you know, modest gains. Hey, I'll invest in this stock and get a modest gain. That's not the right thing for me to do. Modest gain would be earn 4% on my cash when it's sitting on money market accounts, waiting for an awesome stock like a Robinhood within financials, a Robinhood or a Coinbase to start working, or excuse me, come down to a price I like. Coinbase has really flown up, but not too long ago. Boom, good price, good price, good price. So if this guy comes down maybe to $200 a share, it's looking good. I'd buy it at $200 a share. Right now, I'd probably be waiting for Coinbase to come down and just hold my shares. So I think right now is, you know, being patient is the right tempo. We have an expensive market. No need to chase stocks. You can just be patient. We don't have to chase these stocks, because if we chase and we buy high and it drops, boy, it hurts. But your cash, if everything drops, it's going to become a big opportunity. You have the cash around. So good luck with Ali. Good luck building up that cash. What do I think about TEM? Oh, Tempest AI. This came up. I was looking at what Cathie Wood had done. Cathie Wood's owned this, and look at this, 153%. Year to date, 100%. And I know a lot of people give Cathie Wood a hard time, but she's right now. Cathie Wood is ranked number 3 of the super investors. I cover 16 of them. She's number 3. She's ahead of Tom Lee, Howard Marks, Guy Spire, Vinal, Buffett, Ackman, Einhorn, Dorsey. She's up here. So people give her a hard time, but let's take a look at her portfolio, which includes Tempest AI. Let's take a look at Tempest, because I don't know what they do. So it'd be a good time to check out the company. So just real quick, Cathie Wood's made 104% return on Tempest year to date. She's made 177 million for her investors that are invested in the ARK fund. Nicely done, Cathie Wood. Nicely done. And she's crushed it on Circle. Made 289 million. She did fabulous on Palantir, made 131 million. Robinhood, 141 million. Go Cathie Wood. Now, if she wasn't completely in love with Tesla, boy, she'd be number 1 on that list. But Tesla's taken 163 million from her and is her top position. So good job, Cathie Wood. Let's take a look at Tempest. All right, so Tempest is AI. AI means a lot of things. So Tempest AI incorporates as a healthcare technology company. It engages in providing next generation sequencing diagnostics, polymerase chain reaction profiling, molecular genotyping, and other anatomic and molecular pathology testing to healthcare providers, pharmaceutical companies, biotechnology companies, researchers, and third parties. So they do AI within healthcare. All right. So let's get more familiar with this company. So AI-enabled precision medicine. Okay. Okay. So they're going to use AI to help in the medical treatment, diagnosis, research, and so forth. Okay. So this is a $12 billion market cap company. They have revenue of 803 million. They lose a lot of money. Okay. And so they lose a lot of money. There's probably a lot of research and development getting spent. So we'll take a look at the income statement. Okay, so revenue growth, very good. Now, when we look at this, we got gross profit, pretty good, pretty good. Gross profit's good. It's going to be about 60% gross profit. Research and development, that's what I thought it was going to be. $334 million is being spent there. Then they have operating expenses of 1.1 billion. So that's why they lose so much money. They have an expensive cost of doing business in their particular industry. Okay, so they're burning some cash. Let's see how much cash they're burning. They're burning 211 million. It's improving a little bit, but not a lot. Okay, so you're burning 211 million. Stock price is really flourishing. How much cash do they have versus debt? They have $218 million of cash. Debt is 857. Okay, this is a little bit of a concern. They can issue out more stock and generate some cash because their stock price is flourishing, but I think investors would dislike that because you're gonna dilute the company. But this is a debt level, okay? They're not creating a whole lot of EBITDA. So debt to EBITDA doesn't exist because they're losing money. So, man, this is a risky company. Got debt, losing a lot of money. And what it might be is when we look at their income statement, right? You have, see this operating expense? They could be positioning themselves as, hey, our technology does all this AI stuff for the process within diagnosing and so forth. But in the background, they have people that are actually doing the work the old way and basically doing it that way, but they're posturing it as AI. We've seen that in other businesses where there was some company that claimed that they were an AI company and they really had developers in India writing the code. Somebody would put in the AI prompt and then the code would be driven out of India, which was found out to be, deceitful. Not sure how they're doing it, but I think there's too many losses, too much operating expense for me to be an investor of this one. If they really did have AI and it was doing everything they're claiming, why are they spending so much money? Huh? Because I could show you other businesses that out of the gate, they're far more profitable, like Palantir, right? Now, Palantir, I think, is overly expensive, but at least they have fundamentals that you can point to and say, hey, look, so they're a $3 million company, but you can point to these guys and say, look, they're making money, gross profit. They have gross margins and they generate free cash flow. And this is a new business. So back to Tempest AI, it's like, man, when are you gonna be profitable? Why do you spend so much money? I get you're in a hot space. Investors are stepping over each other to try to buy the stock, but not me. You see these swings. Whew. Investors got spooked, sold off. Now we're building the stock price up, sell off. That's what we're going to probably see. 89% for the 1 year. Look at that. Okay, they IPO'd back here June 14th, 2024. So they've been public a little over a year. Interesting. So we'll see. I would not be surprised if we wake up 2 years from now and this is a $30 stock. Wouldn't be a surprise. That's what IPOs do. But we'll see. For now, Tempest AI, people have made money, but I think it's way overpriced. There's a lot of risk in this type of company. I'm okay looking at young businesses that IPO'd not too long ago, but you got to show me that you can make money, that you can generate cash flow. If you can't show me that, then what do we got? So that is Tempest AI. So you're thinking of moving to Robinhood, Cream Biggins. Interesting. Yeah, Robinhood's just Study all the stipulations, right? Because sometimes they make it seem like, oh man, it's a good deal, and then you get in there and you're like, oh no, there's some fees I wasn't aware of. Mm-hmm. So Mike making money on SoFi, good for you. That's awesome. All right, so let me take a peek at the markets, see what they're doing. Make sure they're not doing anything too crazy on us. So we already went over Asia. Europe closed. Futures, they're about the same. Oil's at the same. Okay. So let's see where they open. One area that I thought would be interesting to check out is what's trending, right? NVIDIA getting a lot of views on stock analysis. Circle getting a lot of views. AMD, Palantir. And this stock here, I think is it going to be acquired? This is Ride. Ride Group engages in the provision of mobility and quick commerce solutions in Singapore. The company offers on-demand and scheduling of carpooling and ride-hailing. So this is like an Uber competitor. 15 million. Oh, this is a tiny company. 15 million. And this is in USD. Okay. So that's why the stock, the rate of appreciation is so high, because it's a tiny cap. And revenues 6.56 million. So you're paying 3 times revenue, 2.5 times revenue. This one's going to be kind of a flash in the pan. Revenues 8.95 million. Not a lot of growth, and it's a tiny number. Man, this one's risky. Yeah, no thanks. It's catching a lot of attention, but boy, I could see this stock tanking, and it's a penny stock. So you can go from 45 to 25 real quick. Apple is being searched, Amazon, Aptivo Therapeutics, another tiny cap that loses a lot of money. Another small cap there. Oh, I think I lost my view. So Visa is getting a lot of views. Visa has been seeing its stock slide a little bit with the news that, hey, Amazon and Walmart are going to look at a stable coin. And I've seen a lot of chatter online. And I know some people are like, oh, it's an overreaction. That's not going to happen. Well, UPS and FedEx are hurting because FedEx and UPS lost a lot of the capacity that Amazon is doing on their own. Amazon most certainly would love to get rid of the transaction fees on payments. They would love to do that because they would keep more of the margin. So it's real. Now, it's going to happen overnight? No. It's going to happen over the next 2 to 5 years. But for somebody to say, oh yeah, Visa is going to be fine over the next 5 years, yeah, that's being gullible, because I think stable coins are going to have a position. Amazon's got them, PayPal's got them, Walmart's going to have them. You have a bunch of companies wanting a stable coin so they can be in control of the payment method, and consumers are getting more and more comfortable with crypto, getting more comfortable with stable coins. So we shall see where that goes. But I think Visa has seen its stock come down. Year to date's up 7%, not bad. Over the 1 month, it's gone down quite a bit. It went down from 373 down to 340, so that's about a 10% drop. Nothing to get overly bent out of shape about, but we'll see where it goes. The stock's done well over 5 year, right? This plus your dividend, you're at 80% or so rate of return. That's not bad. But I think the whole value of Visa is that they just keep growing because they have this powerful network that they make a lot of money on. You take that network, they have nothing. So it's going to be like, oh no, the market cap's really high, and you can see a world if stable coins work. This might be a $100 billion market cap company, $50 billion market cap company. It would really lose a lot of value. So it's not going to happen overnight, but just be aware if you're a Visa stockholder, that is a threat. That is a threat to your moat, to your competitive barrier against competition. Is what if somebody comes out with another network and it gets adoption and it takes a lot of the spend to that network? That's what I'm talking about. That is getting through your moat, taking away your business, taking away all that profit and cash flow. So we'll see what happens with Visa. All right, guys, that was a cool stream. Thanks so much for spending part of your afternoon with me. It was a fun one. Let me end it there and invite everybody to become a member of this channel. It's a good channel, got a lot of good investors in it. You'd be invited to the Discord. You'd be invited to member-only calls. You'd see member-only content. On live streams, you can put tickers out there and we'll evaluate them. There's just a lot of perks there, and I hope you can consider being a member. And you can get all the details on the homepage of my channel. And there's a link on the description of this live stream. So with that, everybody have a nice afternoon and evening. Let's see where the market trades tomorrow and see how the market treats us over the next couple of weeks. Thanks, everybody. Have a good night.